Many of you enjoyed my video on why the stock market is overvalued. I showed you the P/E ratio of the S&P 500, which is trading around 19 times earnings, and the average is around 15.8 times. And I told you that over the last 5 years, despite all the stimulus we had, earnings per share of the S&P only grew around 10%. So if the best case scenario is they grow 10% again over the next 10 years, then the S&P 500 is highly unlikely to deliver more than an 8% annual return, and maximum maybe a 10% annual return. And I did tell you guys that there's a lot of different factors that could massively affect this 8%, and it could end up being 5 or 4 or even 6% a year. And the main effect of that is potential outflows from global markets outside the United States. The main reason why we have such a high P/E ratio relative to Europe, relative to other countries, isn't just for better economic growth and better countries in general, but it's also because of the massive inflows we had into the US, which has caused a massive multiple expansion. But this normally goes through cycles. We had it in the Nifty 50, we had it in the internet bubble, and we're kind of having it right now. And if the inflows, they keep coming out of US markets, like what's been happening this year, and other markets outperforming, then that means there's going to be a lot of pressure on the P/E ratio of the S&P 500 and on the S&P 500 stocks in general, which is why I told you guys it's mainly going to be a stock pickers market. And it doesn't mean picking Microsoft instead of the S&P, but it mainly means picking stocks outside the index that will do well no matter what. So you don't have to suffer the outflows, and no stocks are going to do well. No matter what happens to the dollar, no matter what happens to interest rates, no matter what happens to whatever Jerome Powell says or what kind of tariff policy or whatever, inflows, outflows, they don't care. They're going to go up and they're going to do well no matter what. And many of you guys asked me, give us some stocks, give us some ideas of stocks that could potentially do well no matter what outside the index. And that's what I'm going to talk about today. This is something I don't do very often, but I'm going to share a stock with you that I bought 3 weeks ago. It's up a little bit, but I didn't buy it to make 15 or 18%. I bought it to make hundreds of percent. So I'm going to talk about this stock today and let you know my opinion on it. And it's kind of like a stock that I talked about not long ago, and that was Cheniere Energy, which is more of an infrastructure kind of bet in the United States on exports of natural gas. And this stock has done very well, and it's outside the index. It's uncorrelated to the S&P. It's still up this year versus the NASDAQ and everything else being down so much. So this is the kind of stocks I'm mainly holding in my portfolio, aside from some of the big 7 and some of the quality buy and hold forever stocks. And I don't talk about those stocks very often. So if you do enjoy them, all I'm asking is if you could please press the like button and let me know what you think in the comments. And this kind of stock is more, I would say, of a Warren Buffett stock or a Michael Burry stock. It's like, a hated, unloved, deep value stock that's actually growing. It's not declining, it's actually growing. And this is mainly a convenience store stock. I talked about a lot about the convenience store stocks. One of them is ATD Alimentation. They own, convenience stores, gas stations, car washes, boring stuff. But even such a boring business is up 15,300%. It's one of the best performing stocks of all time. It has done well in inflation, recessions, no matter what happens in the world. ATD has done well, and it's going to continue to do well. And there are so many of those convenience store stocks, not a lot of people talk about them. One of them is Casey's General Stores. Casey's is up 30,000%. This is not a tech stock, this is nothing, and it's still up this year. It just keeps on going up. No matter what happens in the world, those stocks, they keep compounding capital and they keep on going up. So I was determined to find my own kind of, convenience store stock that I can buy and hold forever. And that stock may not be too sexy, may not be the highest growth stock ever, but the magic is going to continue, and they're going to keep compounding, and they're going to keep doing well no matter what. And this stock is Musa, which is Murphy's USA. Murphy's USA is another kind of convenience store stock, and they went public through a spin-off, I believe from Marathon Oil, back in 2013, and the stock since then is up 1,279%. Over the last 5 years alone, it's up 374%. That's not bad for an old, boring convenience store stock. And I don't know how that happened, but I caught the bottom on the stock, and I bought it at 435. That was the exact day I opened my position and the stock bottomed out. Then I averaged up a little bit, and it's up around 18.5% from my cost basis. But I always tell people I did not buy Musa to make 18.5%, and the stock still has a lot of potential despite it being above my cost basis. But Murphy's USA, they own convenience stores in the United States, over 1,760 stores in 27 states, and they serve over 2 million customers per day. Pretty amazing. Now, I did show you the convenience store business model and how well it has done over the last 10, 20, 30, 40, 50, even 60 years. It has done so well. But this kind of business model is facing two main challenges as of the recent times. And the first challenge that this business model is facing is EVs, which is electric vehicles. Especially in Europe, there's high penetration of EVs, and those kind of companies, they make money on fuel margins, and they also make a lot of their money through selling you things in the convenience store. When you buy gum, or you buy beer, or you buy lottery tickets, or you buy whatever, this is also how they make their money. So the kind of EV penetration trend has really been affecting those convenience stores, especially in Europe and especially in other areas. But Murphy's USA is actually shielded from this kind of threat. And if you look at this chart, this is the national average, and they're mainly in the United States, which is good. ATD is international, it's in Europe. Europe has higher participation rate, or I should say penetration rate, in terms of EVs. But if you look at the US, the national average is like, as of 2022, is less than 1%. But Murphy USA states and locations are even less than 0.5%. And this is mainly because Murphy's USA is more of a discounted kind of convenience store. So you could say it's kind of like the Walmart of convenience stores, or the Dollar General of convenience store. It's like the lowest priced kind of items, and it's mainly located in lower income kind of neighborhoods. So in the lower income neighborhoods, not everyone is privileged to buy a $50,000 or $60,000 EVs. A lot of those people, they drive old cars, old gas cars, or whatever it is, and they just drive them. They have very low EV penetration. So in terms of the locations of where Murphy's gas stations and convenience stores are located, they're largely shielded from whatever ATD is facing in Europe, and they're facing in other more affluent areas where people have 50 or 60 or 70,000 to buy an EV. But a lot of people in lower income neighborhoods where Musa is located, they don't have the privilege of buying such an expensive EV. So they have old used cars, 10, 15 years old, they use them. So they're really shielded from the biggest threat that's facing convenience stores, which is mainly electric vehicles. Now, the second threat that's also kind of disrupting, and it's really killing the business model of convenience stores, and ATD is facing massive challenges from this, and this is mainly the declines in nicotine products. Now, nicotine products, they contribute around, on average, 10% of the sales in a general convenience store, and they contribute very high margins. The highest margin stuff, they're beer, nicotine, and also lottery. Lottery is very high margin for those convenience stores. So a lot of, for example, ATD is facing 5 to 10% decline in nicotine sales. But again, because of the locations of Murphy's in lower income neighborhoods, they're still actually seeing increasing nicotine sales. So the nicotine contribution over there, it went from 18.8 to 19.4. So this is the second biggest threat to this amazing business model, which is also, the nicotine sales. Those are going up, and are largely shielded from the biggest threat of them all, which is mainly electric vehicles. So then I know that whatever has worked over the last 20 years is going to keep working over the next 20 years, and I'm shielded from all those threats because I own Murphy's USA, and that's kind of why I believe the stock is much better than ATD. And it's also much better than Casey's General Stores. But what's really special about this one, and what I really liked about it, is they own 1,757 stores. Out of the 1,757, they own the real estate on 1,309. So 75% of their stores, they own the real estate, they own the land, they own the building. And that helps them a lot in terms of saving costs. ATD doesn't own their buildings. They do a sale lease back, and they rent it from a REIT, which sounds more efficient, but then the rent escalators kick in, and they have to keep getting squeezed on margins because they have to pay more and more in rent. But it's the same way you own your house, and then you just pay your taxes and insurance once it's paid off. It's the same thing for Musa. They own prime real estate that's paid off, and they don't have to pay rent to anyone. They own the building, they make their own decisions, and I really liked this one about it. But out of those 1,757, 65% of them, or I should say 69% of them, are located near a Walmart. So this is strategically located maybe in less than half a mile from a Walmart, sometimes on the same exact property. And they even have a partnership with Walmart, where if you have Walmart Plus, they give you like 10 cents off per gallon on your Murphy can of gas. And I went to a lot of those Murphy's locations, and most of them were strategically located like almost adjacent to a Walmart. So this is prime real estate that they own, 75% of them, and 69% of them are strategically located near a Walmart. And I just fell in love with the business model once I listened to the CEO and once that I saw the annual report and everything around it. Now, the company is growing in two main ways. The first way they're growing is they still have a lot of kiosk kind of stores, kiosk where you can't even go in the store. It's a tiny store. Sometimes they give you products from the window. Maybe it's just an old kiosk. So they're taking those kiosks down and they're building them into 1,400 square foot stores. And you can see the massive difference in fuel gallons. It jumped from 210 for a kiosk to 276,000 for the 1,400 square foot store. And it's the same thing for merchandise sales from 157,000 to 216,000. So they're seeing a massive difference in those, and it's helping their growth. And in 2024, they did 47 of them, which they call raise and rebuild. Now, the second way they're also growing in revenues is by doing new stores. So new stores, they did 32 in 2024, and they're building up to 50 new stores in 2025. The company doesn't like mergers and acquisitions too much. They love building their own stores. They love choosing the locations, and they have a lot of potential with the raise and rebuilds of taking those old kiosks down and putting brand new stores where they have a fountain drink. Those fountain drinks are also high margins. Half of them are water and ice. I mean, you know how it works. So that's a very high margin stuff. And they've been finding a lot of success with that. Now, something I want to mention about the company is something that, Charlie Munger called them Uber cannibals, where they cannibalize the stock and they keep buying back so much stock. It's insane. It's the same thing with Murphy's USA. They have a tiny dividend, but the company has bought back more than 60 or 65% of their shares outstanding since they went public. And shares outstanding is beautiful. It went from 46 million shares to 20 million shares. And this is amazing capital return to shareholders. And that kind of guarantees that there's always a bid on the company where the company is buying back 4 to 6 to 7%, sometimes 10% of their stock in a given year. And that's just an amazing value creation, in my opinion, from Murphy's USA. And it's also very efficient. Now, if you look at the company's EBITDA, it kind of peaked in 2022, and in 2023, 2024, it has decreased. And many people will look at the financials and they would freak out because they see declining in sales. That means the company is trash, without them understanding that 2022 was a special year. And we had something called the crack spread, which is a spread that's used to determine gasoline prices on the pump. It went to the stratosphere because of what happened in the Ukraine war, and a lot of the refining capacity in Ukraine and maybe in Russia had to shut down, and then the cracks spreads blew up, and this is what has caused massive increases in prices at the pump, which was very beneficial for Murphy's USA, and they captured a lot of margin. So that was, for example, 2022 was what 2021 was for Nike or for many stocks, where they peaked in revenue because everything was amazing, and then everything went down further. And whenever oil prices go down, that also affects the company's sales a little bit, as almost 50% of their sales, they come from fuel margins, and that's going to affect them a little bit. So we had, decreasing crack spreads and decreasing margins in 2023 and 2024, and that's why their sales went down. But before 2022, they were actually going straight up, and now 2025 for EBITDA is going to reaccelerate, and after 2025, as oil is likely bottoming out, it's going to get much, much better from here, and it's going to be much, much better. So this is the first reason why they had stalling or declining in sales. But the second reason why is because I showed you that they're doing all those raise and rebuilds where, they do around 47 in 2024 and they're doing 30 in 2025. Now, for them to build a new store, they have to shut down the current store for 3 to 6 months. And that's also affecting sales for 3 to 6 months. And it's waiting on the results. So looking at past performance isn't going to give you a clear picture with this one. You have to understand why it has happened and why it's likely going to get much better from here. Now, if you look at the PE ratio, it's trading at 19.7 times earnings. And I bought it, it was around 17 times. And a lot of people told me 17 times earnings is overvalued. Even if you look at it right now, 19 times earnings is overvalued. But again, it's not so easy. Investing isn't so easy. And you have to dig in a little bit deeper. So because the company owns 75% of their real estate, they have a lot in depreciation and amortization expense. So this is something that you have to add it back to net income to get a fair PE ratio. So in this case, for net income guidance for 2025, it's expected to be as high as 551 million. Okay. Now, if we add in 250 million in depreciation and amortization, this is around 800 million in net income. So if we take the market cap, which is around 10 billion, and we divide it by the adjusted net income for depreciation and amortization, which is around 800 million, we get a PE ratio of 12.5. So the company is only trading at 12.5 times earnings while growing earnings 10%, 9%, 9%, 10%. This year is expected to be slow again, around 5 to 6%, but it's likely going to continue growing again 10, 11, 12%. So if you look at it this way, the stock is very cheap at 12.5 times earnings, growing earnings 10%, and I believe they will likely be able to grow more than 10%, especially if they have a favorable environment with crude oil and with everything else. But the second way to value the company is if you want to use the free cash flow yield. But the main thing with the free cash flow yield is it looks very low because they have a lot in CapEx. And most of their CapEx is in gross CapEx. 400 million is in gross CapEx. They only need 100 million to maintain operations. So if you really want to find the true value of the business without putting in the gross, you have to take in gross CapEx out of cash from operations. So in this case, again, we could take out 842 million. This is cash from operations, or I should say 800 million. And we take out from that around 100 million in gross CapEx, and we could do the calculations again. I did it for you. So the free cash flow yield is around 7%. So I'm buying the stock at either a 7% free cash flow yield, growing sales 5 to 6%, or I'm buying it at around 12.5 times earnings, and it's likely going to grow earnings 10, 11 to 12%. This is dirt cheap for a company that has a recession-resistant business model that's going to do well if we have inflation, if we have a recession, if the dollar goes up and down, if whatever happens in Europe, whatever war happens, Jerome Powell, whatever he says, whatever Trump says, the company is going to do well. To me, this is an amazing, amazing business model. And they have compounded around 23% a year in CAGR over the last 10 years. And I personally believe they will likely do it again. But for me to value the company, Murphy's USA, I'm going to use their own targets. And they have a target of 1.3 billion in EBITDA by 2028, and they have 17 million in shares outstanding. So in other words, they want to buy 3 million more shares by 2028, and I would not be surprised if the company ends up exceeding that. And the company right now is trading around 10 times EBITDA. They're expecting a 10 to 12 multiple in terms of EBITDA. So the way I would value Murphy's USA for the next few years is I would take their 1.3 billion in EBITDA. Okay, and I would time it by a 10 multiple. Although the company will likely get a multiple expansion, but I'm just using a 10 multiple to keep it simple. This is $13 billion in market cap. I divide it by the total shares outstanding by then, which would be around 17 million. That would give me a share price of $764 per share. The current share price, after it's gone up 18% since I bought it, is around $513 per share, which means Murphy's USA or Musa still has 49% on the upside from now to 2028. So this is another 50% on the upside over the next, you could say, 3 years. This is an amazing return with a company that's a recession-resistant stock that's going to do well again, no matter what, that's outside the index, and they're just going to keep building those stores, raising prices, doing certain things, and they're going to do well no matter what. So this is why I like the stock very much. Maybe it was a little bit more attractive at 435 when I bought it, but even right now at 513, I'm still seeing around 50% on the upside, and this is using a 10 multiple. If I used a 12 multiple, it's entirely different. If we take the best case scenario, we take 1.3 billion, we time it by a 12 multiple, this is 15.6 billion in market cap. And if I divide it by 17 million shares outstanding, which will likely be less, this is $917 per share. If I divide it by the current price of 513, this is 78% on the upside over the next 3 years with a company like Murphy's. And yes, they have some debt, but they have a lot of assets against them. They have robust free cash flow. To me, this is an amazing value proposition. So that's why I love the stock very much. I'm holding it for the long term as a kind of a buy and hold forever that's going to keep compounding and it's going to keep doing well no matter what. Now, they have earnings coming up soon, and they had to close down some stores in Q1 due to some storms. So maybe you get an entry if the stock does go down. But if you're looking more for timely updates, whenever I buy such stocks, whenever I find them, whenever I do anything, I share them all in my own Discord. And this is the link if you're interested. But that was my idea for today. I hope you consider it. I hope you research it. I hope you don't skip it just because it's up. I've done this mistake before, and it's normally a bad idea. But you should do your research and be comfortable with an investment before buying it, because I could always change my mind and I could always be wrong. So thank you very much for watching. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.